Hello and welcome to Within the Frame. I'm Han Da-eun in Seoul. The South Korean economy grew at the fastest pace in more than 2 years in the first quarter, beating expectations. But the sustainability of this recovery remains murky as global uncertainties linger. The $1 exchange rate teeters near the 1,400 mark, while volatile oil prices add to the unpredictability. And market focus intensifies as we await crucial U.S. data this week, poised to influence the Federal Reserve's rate decisions. Global economic landscape amid high uncertainties, that's the topic of our discussion today. And for some insights, we connect to Song Soo-young, professor at Chung-Ang University's College of Business and Economics. Always great to have you with us.
Thank you for inviting me.
For another voice on the topic, we also have Greg Buchak, professor of finance at Stanford Graduate School of Business, joining us tonight. It's always great to have you with us.
Great to be back.
Professor Song, the first one's for you. South Korea's GDP grew 1.3% in the first quarter, beating expectations. What boosted the surprise quarterly growth, the highest in over 2 years?
Yeah, the report, according to the report, is quite impressive. As we look into the details, clearly the net export plays a most important role. According to the publication by the Minister of the Finance and Planning, they have a 3.9% of increase, annual increase of the net export plays a really huge contribution to the current surprise GDP growth rate for 1.3% for the quarter. However, we have to bear in mind what needs to bear in mind is that because this is mostly driven by some big companies such as Samsung and Hyundai. However, clearly when you see the business survey index and the consumer sentiment index, clearly there is for the big companies, the index has been increased 3.0, bigger than, larger than, but however, increased for the business survey index. But for the small and medium companies, they have decreased by -1%, -1 for the BSI, so business survey index. So to that regard, we have to be, whether, as you mentioned, the sustainability is suspicious and quite suspicious. So we should not just remain complacent about this surprise performance because of the semiconductor and considering the global market situation. It turns out to be favorable to the big company, but they have delivered the benefit to the foreign consumers, not the domestic. So that is the key issue should be addressed in the following upcoming period.
So robust exports was one of the primary factors that led the growth, but you've highlighted that we shouldn't be too complacent about it. And future growth also remains uncertain amid persisting risks, and oil price is one of them. Professor Buchak, oil markets saw a muted impact from the Middle East risks as Iran and Israel averted a full-scale war. But price uncertainties linger as the U.S. Congress passed new sanctions on Iranian crude oil. What's your outlook for oil prices going forward?
Sure. So I really think kind of for political reasons around the upcoming U.S. election, we're going to see the U.S. government really doing all it can to keep oil prices low. So the main determinants of oil prices is really global demand and global supply. On the supply side, these are things like questions around whether the conflict in the Middle East will escalate. You know, one of the big reasons the Biden administration is urging so much caution from the Israeli side is to keep that conflict in check and from disrupting the global oil supply. On the demand side, factors sort of like, is the global economy growing or shrinking? That's really what's going to determine prices. This issue around sanctions on the other hand, they're sort of more around who buys from whom. And the important thing to remember there is oil is just as good from anywhere, from Iran as it is from anywhere else. So policies that sort of don't impact total production, but only the specifics of who's buying from whom, they're going to be a little bit less important in prices. Now, the reason is that, you know, if sanctions say an American firm can't buy Iranian oil, trade networks can very easily route their way around that. Okay, so American firms may have to buy from somewhere else, and that Iranian oil isn't being sold to the West, but it can still be sold to other countries like China. Okay, so this just has the effect of sort of reshuffling trade networks rather than impacting aggregate demand or aggregate supply. Now, the latest US sanctions bill, it actually does try to plug those holes by including what are called these secondary sanctions. And these secondary sanctions are sort of sanctions that are on firms that do business with Iranian oil producers. So this could have a real effect by kind of completely taking Iranian oil production out of the global supply. But sort of back to what I said in the beginning, it turns out that the American bill actually comes with a waiver that allows President Biden to not enforce these secondary sanctions. And analysts actually are sort of expecting that, given domestic political concerns around the upcoming election, Biden's not going to enforce them in order to keep gasoline prices low in the U.S.
So President Biden will try his best not to let oil prices rise further before the November presidential elections. So we'll be watching closely on what happens in the U.S. and the Middle East as well as elsewhere. But for the time being, oil prices remain relatively flat despite heightened uncertainties and geopolitical risks. Professor Song, what's behind the reduced magnitude of oil price fluctuations compared to the past?
Yeah, when we look back, the magnitude of volatility of the oil price, particularly the Western Texas Intermediate price, has been great. I mean, absolute price is very low in the 1970s, 60s, because at the time the per barrel price is comparison just at $20, but it used to be $3, $2, but suddenly it becomes $20. So in terms of the magnitude of volatility, it was quite big in the 1970s during the OPEC crisis. However, recently we have seen that in the year of 2008, the oil price has reached almost $139 per barrel, but has been reduced and fluctuate over the next decades, or currently it has reached $83.5 for the Western Texas Intermediate future price. I think of Professor Buchak has mentioned some kind of some alternative supply and alternative way to find purchase the oil. But the primary reason why oil price cannot be, the fluctuation becomes smaller is because of the new oil fields such as Rosebank in the Dorset Sea in Britain and Scotland. And also Guyana oil field just next to a very shore of the Caribbean Sea. It's going to be huge in terms of, so the supply is, reservoir is very big. And also China has developed some kind of oil field in the Taklamakan, western side of the China. So to that regard, clearly the supply is accumulated behind. And considering that, also Canada and the U.S. oil sand technology has developed. As long as the oil price goes up, there is incentive to produce such oil to sell it to the world market. So that means it's very difficult to maintain the cartel among the oil export countries around the world, because always there is an incentive to free ride. The increase the price, then Canada and the U.S., but maybe not U.S., but Canada has the incentive to produce oil sand oil as long as $50 per share per barrel is really some kind of the trigger level of the price to produce to supply more. And also we know that, as Professor Buchak mentioned, Iran, and also there is Russia. Because of the sanction, Russia has a very strong incentive as long as they find some chances to sell it. So that's why it keeps the oil price remains stable.
It looks like more diverse factors are now acting as variables that impact oil prices. Now, staying with you, Dr. Song, fluctuations were much higher in the foreign exchange market. The Korean won dropped over 7% against the dollar, which marked the sharpest fall since the 2008 financial crisis. How do you assess the current FX market volatility?
Current market volatility is quite big for Japan, because it has reached almost 154 as that is the the largest depreciation of Japanese yen against the US dollars since 1992 or 130. But before that, even during the 1970s, early 80s, actually, the exchange rate for Japanese yen against US dollar has been almost 350 yen per dollar. So at that time, the Japanese economy is relatively a small economy in comparison to the United States. But because of the 1985 Plaza consensus, and then the U.S. just coerced the Japan to appreciate its value against U.S. dollars, and that is the start of some lost decades of the Japanese economy. And considering the Korean won against the U.S. dollar, it was really 300 to 1 and 400 to 1 in 1980s. But at that time, our economy was quite small and under developing economy. So therefore, the size of our per capita income is very low. But however, as we make some progress in terms of the GDP and wealth and income, per capita income, we have seen that the Korean won has fluctuated around some 1,200 won, Korean won against the US dollar. So recent surge of depreciation of Korean won against the US dollar is primarily because of some imbalance between the supply and demand, and because of the interest rate difference plays a very big role. However, this is very favorable environment for the big companies such as Samsung and Hyundai to make an export. But it is not good for the domestic economy, particularly for the middle and the small enterprise, small companies who relied on some raw material supply and oil or energy source and even food. That is really bad. So considering the current situation, there is clearly the tendency of divergence within the domestic economy for the big companies gaining some momentum to make a progress. But however, the domestic small and medium and small companies now they still suffer from some low growth rate of the economy. So that's why we have seen that the exchange rate have changed, is very uncertain and subject to how can I say? But I hope it remains. It will be stabilized around the later part of 1300. Okay.
I certainly hope so, too. And in related question, Professor Buchak, the decline in the value of the won was the 7th largest among the 26 economies considered by the U.S. Fed in its calculation of the dollar index. From your perspective, why is the Korean won more vulnerable than other currencies?
Sure. Well, I think I totally agree with what Professor Song said. I think this is really a story of the dollar being strong rather than the Korean won in particular being weak. So before getting into sort of the specific Korean story, I think it's worth thinking about why is the dollar so strong. So the US economy has remained very resilient with decent growth, low unemployment, even in the face of these higher rates coming out of the Fed. And so this economic strength suggests that interest rates in the US are going to remain higher for longer than many have expected. And high rates tend to be good for the country's currency because people want to buy dollar-denominated assets and earn those rates. Second, there's sort of the inverse coming from the fact that growth in a lot of other economies has been a little bit weaker, so their interest rates are lower. And then finally, I think there is a real sense of sort of growing global instability, and in a time like this, US dollar, US assets are sort of seen as a safe haven. And so people are sort of buying into them for that reason. So that's all just a story of dollar strength. On Korea in particular, I think, for some people, there's still this memory of the Asian financial crisis in 1997. The won depreciated almost 50% nearly overnight when the government kind of ran out of dollar reserves. There's sort of this like psychological level around this 1,400 won to the dollar rate. The won hit that recently, and it's only been there, I think, 2 times in history before. Once during the global financial crisis in 2008, and then once during the Asian financial crisis. But again, like I wouldn't panic. I think a lot more of this is about dollar strength than won weakness. It's true that, in a basket of 26 other currencies, the won was in the bottom half, but it's not really a dramatic outlier. As we talked about, there's just positive GDP growth news in Korea. That'll be good for the won. I think sort of for these reasons discussed, the dollar's been very strong, and a lot of people in Korea actually benefit from a weak won. If you're an exporter, this is very good for you. If you're a consumer, it's not so good. But I don't think it's really time to panic.
And how long do you project the dollar strength to continue?
It's going to stay strong as long as rates in the U.S. are high, and I think rates in the U.S. are going to be high for a while until the economy slows down.
And Dr. Song, finance chiefs of South Korea, the U.S. and Japan held their first ever meeting last week where they hinted at joint action against FX market volatility. What impact would the verbal intervention have on markets, and what action can we expect if market volatility persists?
Yeah, both the finance minister from Korea and Japan has met Janet Yellen, the Treasury Minister of the U.S. at Washington at the meeting of IMF conference. The reason they have a meeting is because they would like to make some excuse, particularly because both countries, Japan and South Korea, do not want to be blamed as some manipulating exchange rate country. So they would like to get some implicit permission from the U.S. Okay, we are going to intervene the exchange rate. We do not want to let it go according to the market situation. So that is justified or legitimized because of the recent development of Japanese yen and the Korean won has been depreciated. Its value has been depreciated against the U.S. dollar. So that is true. But when we consider the value of U.S. itself, the U.S. dollar index, which is the value against some 6 different countries' currency, and now it's still it is very volatile. But however, the dollar becomes very strong. Even with that, the depreciation of Korean won and the Japanese yen has worse than those strengths, improved the strength of the U.S. dollar value. So that's why they gather and meet with Janet Yellen and to gather some kind of some implicit agreement, not to point out both countries as some manipulating, because there is some sanctions could be possible. That's my opinion. And also, as Professor Buchak has mentioned, whether currently in the April still there is some slight chance of the U.S. economy growth rate has been declining a little bit, and also there is some posting of the job unemployment has been increased a lot, not a lot, I mean slightly. So there might be a signal. So at least 2 or 3 times of the decline of the interest rate is possible. But however, what we need to focus on is the European Central Bank. They have maintained the current status to stick with the principle of in June, the interest rate will be declined until now, at least. So we have to wait and see what would be the development of the economic condition in U.S. and Europe.
Professor Buchak, we're expecting important U.S. data this week. The country's first quarter growth and the personal consumption expenditure price index will be released. What are your projections, and how will they shape the Fed's next rate-setting decision?
Sure. So the 2 big ones you mentioned, GDP growth for the first quarter and the PCE, which is a measure of inflation, that's coming out for March. On the GDP side, market participants, they're expecting pretty robust, steady growth. As Professor Song mentioned, there's a few cracks here and there, a little bit more people seeking jobs, unemployment rate fluctuating a little bit around a pretty low level. I don't think there's going to be a dramatic departure from the trend, which has been pretty steady growth, low unemployment. I think that's what we're going to see for a while. On the inflation side, now there's sort of like two closely related, slightly different measures that the Fed looks at. There's the CPI and the PCE, and the PCE is what we're about to see. Both of these measures point a similar story where inflation has moderated quite a bit from its highs, but it still remains a bit elevated relative to the Fed's target of 2%. Okay, so actually the CPI already came out for March. And what we're going to get this week is the PCE over the same time period. The CPI was basically flat. It rose slightly. I think we're going to expect something similar for the PCE. The PCE has been a little bit lower. The weights it puts on housing and some different assets that have appreciated a little bit more in price are a little bit lower. So the PCE has been lower. But for the most part, the CPI and the PCE have been tracking each other. So we're just going to see sort of like more of the same. We've already had the CPI spoilers. The Fed is watching these numbers very closely. The narrative around this whole economic cycle has been inflation was high, the Fed raised rates to reduce it. The typical expectation there is that higher rates would bring down inflation but hurt economic growth. And once we start seeing that economic growth declines, the Fed would start lowering rates. So what's actually happened is we've mostly brought inflation down, but economic growth and unemployment has remained economic growth has remained high, unemployment's been kind of low. This has led the Fed to sort of push out further and further and further the time at which they're thinking about lowering rates. And even as we see these inflation measures tick up a little bit, there's been some talk, I think it'll be unlikely, of higher for longer or maybe even slightly higher rates. But really what everyone is waiting for is this clear, consistent sign that inflation is where the Fed wants it and growth has sort of turned some corner. And until we see that, rates are still going to be where they are.
Well, markets expect interest rates to be held steady at next week's Fed meeting and will continue to watch closely for clues on when interest rate cut might occur. We have a few more grounds to cover, but due to time constraint, we'll have to leave it there. But thank you, as always, Professor Buchak and Professor Song, for the enlightening discussion.
Thank you, and good evening to you.
Thank you.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.